Okay, so welcome to homework number 11 over taxes. All right. It's warm. Okay. A man is single and earned wages of $55,100. He received $390 in interest from a savings account. He contributed $410 to a tax-deferred retirement plan. He had $25.40 in itemized deductions. Calculate his gross income, adjusted gross income, taxable income. Use the table to the right for exemption and standard deduction values. Okay, so the person's gross income. So the gross income is everything you brought home during the year. So that would be any wages, tips, scholarships, interest, money from a car you sold. That all counts as a gross income. So the gross income here looks like it's going to be, so gross income is, 55,100 in wages, and then he also received 390 from interest. 410. Okay, so that takes care of his gross income. Recognize this 410 is a contribution to a tax-deferred retirement plan, so that will be considered an adjustment. So we'll use that 410 when we calculate his adjusted gross income. So for now, the person's gross income is going to be the 55,100 plus the 3090. So 55,490. I think I did that in my head right. Moment of truth. Yay. All right, on to the next one. Person's adjusted gross income. So under this one, we want to take into account that he contributed $410 to a tax-deferred retirement plan. So we're going to remove this 410 from our gross income. So adjusted gross income is our gross income, 55,490, 55,490. And we're going to subtract off his contribution to the tax-deferred retirement plan, which is $410. 55, take away the 4, leaves me with 9, take away the 10, leaves me with 80. So it looks like 55,080. $55,080. Moment of truth. Hey. All right. In determining taxable income, should the person claim the standard or itemized deduction? So you get to choose if you want the itemized deduction or the standard deduction. So, and you want to choose the bigger one. So if you look at these notes here, deductions, standard deductions are a fixed amount. Itemized deductions, it's really based off your lifestyle. So this individual had $25.40 in itemized deductions, or they could take the standard deduction of $6,100. $6,100 is more, so we're going to choose the standard deduction. Recognize we want the largest deduction because the larger the deduction, the smaller my taxable income will be, and the smaller the taxable income, the more of my money I get to keep. It's a novel idea. All right, the person's taxable income is blah. So taxable income is going to be the adjusted gross income, which was the $55,080. And we're going to remove exemptions and deductions. So exemptions, deductions. So deductions we already stated. We're going to do the standard deduction. So that would be the $6,100. Exemptions. What are we told about exemptions for this individual? Calculate the growth. He had itemized deductions. Didn't say anything about any extra exemptions. No. So this individual gets to claim one exemption. So exemptions is based upon your family size, essentially. So you get a fixed amount for each dependent you have. So you get to claim yourself as a dependent. Makes sense. So, exemptions per person, it looks like 3,900 were allotted. So one thing to keep in mind is that a standard deduction and a single exemption, they total to $10,000. And also take note that when we were doing this, we were told that a man is single, so we need to use this single column here. So finishing this out, the taxable income is going to be the $55,080. Remove 10,000 of those dollars, so you'd be left with $45,080. All right, 45,080. Moment of truth. Hey, all right, cool. Woman is single, earn wages, a blah. So this one is a repeat of the last one. See if there's anything that's different towards itemized deductions. Yep, same song and dance. For this one, so keep in mind for this one, Sarah is married. They're filing separately, so you'll want to use this column, the married filing separately column, when you do your exemptions and deductions. It looks like they're the same, but get used to using the separate column for the separate scenarios. She had 5280 itemized deductions. Okay, so similar song and dance for this one. Okay, the primary distinction here in this one is that the claiming of 5 exemptions for herself and 4 children. So when you go and look at these exemptions, so you get 3,900 for each exemption. So recognize in this problem, you would take the 3,900, multiply it by 5, there's 5 exemptions, and then add the standard deduction, and then that total is what you get to remove from your adjusted gross income to find your taxable income. So keep in mind, in this one, there are 5 exemptions, whereas the last one, we only had the 1 exemption. More of the same. All right, here's what I'm looking for. Use the marginal tax rate in the table below to compute the tax owed in the following situation. All right, so Sarah is single and had a taxable income of $35,800. So the tax owed is, okay, so recognize this is her taxable income. So this is essentially where we left off in the last example. So we need to take this taxable income and run it through this government chart to figure out how much money we have to give up. So you can use this chart that's provided in MyMathLab. However, I constructed one for you, and it's also available on Brightspace in the notes. I like the looks of this bar chart more than I do this chart. So we had a taxable income of $35,800. How is she filing? She's single, so 35,800. Okay, so recognize 35,800 sits right below the 36,250. So that 35,800 is going to land her in the green tax bracket, which is the 15%. So let's go ahead and take a look at this. So Sarah filing single. She has a taxable income of $35,800. Okay, so recognize 35,800 lands you just below the 25% tax bracket. So do recognize that this income tax rate is graduated. So we're only going to take 15% of Sarah's money if it falls above 89.25 but below 36,250. So we're going to take, so tax owed is, well, we'll start off at 35,800. That's what you made. And then we need to subtract off the bottom of that tax bracket, which is 89.25. In that chunk of money, anything that sits in between that 35,800 and 89.25 is going to get taxed at the rate of 15%. And then we also need to add in the amount of money that's going to come from the 10% bracket, and that's everything between 89.25 and $0. So recognize, I'm starting at so I take her taxable income and I place it on the bar graph. So 35,800 lands right below the 36,250. So that tells me she's in the 15% bracket. Now, we're not going to take 15% of all of Sarah's money. We're only going to take 15% of her money that is above 89,250, or 89.25 rather. So this section in green is what's getting taxed at the 15% rate. This section in blue, so between $0 and 89.25, you get taxed at the 10% rate. Recognize anything between 36,250 and 87,850 is going to be taxed at the 25% rate. Anything between 87,850 and 183,250 would be taxed at the yellow rate, which is the 28% rate. So notice the amount of tax that we're taking is broken up into segments. This is a graduated tax, is what this is called. So let's appeal to our calculator. 35,800 minus 89.25 times 0.15 plus 89.25, and I know minus 0 is redundant, but just to maintain consistency, 4923.75. All right. So the tax owed, make sure we don't have any tax credits. No tax credits. Okay. So the tax owed, do we have to round? Round to the nearest dollar as needed. Okay. So 49.24. 49.24. Yeah. All right. So similar song and dance here. Bobby is married, filing separately with a taxable income of $67,100. So married, filing separately, that would be this bar graph. 67,100. 67 is going to land you towards the top of the 25% tax bracket. So anything in between 67,100 and 36,250 will be taxed at 25%. Everything in between 36,250 and 89.25 will be taxed at 15%, and from 89.25 down is taxed at the 10% rate. So same song and dance here. All right, here's what I wanted to point out with the tax credit. So a tax credit, how do you handle a tax credit? So you do what we just did. You find the tax that's owed, and then at the very end, you remove the tax credit. So say, in this example, if we had a $6,000 tax credit at the end, well, here's our tax owed, $49.23 and 75 cents,
and we would remove our $6,000 tax credit, and that would tell us, well, you have to pay a negative $1,076.25. Well, paying a negative amount really results in you receiving $1,076.25. So this tax credit is handled at the very end. So you run your taxable income through the government chart, you figure out how much the government gets to steal from you, and then from that number you remove the tax credit. And then that tax credit is essentially the last step. So you figure out the tax owed, and then from that tax owed you remove a tax credit. Tax credits are good. Very good. Same song and dance here. Alright, so that should be enough to get you through the taxation. Good luck. I'll see you on the next one.